Hey everyone, today I'm going to go through Netflix's Q4 2022 earnings that they just released, also looking at 2022 as a whole and kind of some of their outlook for their business. We're going to look at the report itself, but also look at a couple of the clips from their earnings call, some things that I found interesting and want to react to. We're going to wrap up just by looking at stock reaction today in after hours trading and my thoughts on the company as a whole, the valuation. Would love if anyone who owns Netflix stocks looking at investing in Netflix leaves their comments, their points of views down below as well. Would love to have a conversation with you guys on this one because definitely a very interesting company in the media space. So I'll just start off with looking at their result summary chart. Probably the biggest number that jumps off the page here is global net adds. So they added over 7.5 million subscribers in Q4. If you just look over the last 3 quarters prior, you can see they were really struggling to get a lot of traction, lost subscribers a couple of quarters in a row. I know there's some Russia impact probably in Q1 here. That's why they missed. But then a true miss in Q2, I believe. Grew modestly about 1% of overall subs in Q3, and then it really ramped up in Q4. Now, going back, it looks like Q4 tends to be their big ad month, ad quarter rather, but definitely promising, especially seeing what happened to this stock price over the last year, 18 months, to see them get back to those levels of growth on total subs. So I think that was super promising for their overall business. In terms of revenue, they definitely have a lot of exposure to international markets. So with the strength of the US dollar, they did see some weakness. I'm assuming that's one of the main drivers there of missing or sequentially declining revenue despite global streaming ads. I don't think this is down because of trade down to their advertising tier that they launched this year, just because it's still very new. There's rumblings that it hasn't been overly successful of a launch. So I don't think there's too many subs in that tier yet to drag down the ARPU. If anything, they've also said that they're positioning the ad tier to be revenue accretive per user. So I think this is mostly FX, but maybe we'll uncover some stuff as we go through the report. Overall, relatively solid quarter, especially backed by the subs. Free cash flow positive, shares roughly flat, and net cash flow provided of almost $500 million. And they also provide some guidance. So they're guiding to 8.2 billion for Q1. And then if I just look over 7.8 billion, so modest growth, about 4% growth, but at least they're moving in the right direction despite some of the challenges and increased competition in the space. And they're once again projecting profitability. $3 give or take of EPS is typically what this company does. It just really depends where costs land, really swings their EPS on a quarter by quarter. But over the course of a year, in normal instances, they're probably on a run rate to make about $1 a month in EPS, so $12 a year. And that's worth noting here. I think there was some European bond element or something unconventional occurred to drag down EPS. But overall, at current levels of their business, they tend to make close to $3, give or take, plus or minus a couple cents of EPS a quarter at this point. So they're projecting that same level in EPS for Q1. Some revenue growth, continuing to be operating margin positive and provide good net income to the bottom line. So definitely not a blowout forecast that's going to knock too many people's socks off. But good to know that they see the business still trending upwards. It looks like they stopped forecasting subs, which it'll be interesting to see market reaction and analyst thoughts to that. But I think they're trying to focus more on revenue growth given how developed the business is. So let's move on here. One thing that was interesting is Reed Hastings, who has been at the front of Netflix for a long time now, finally stepped down as one of the co-CEOs. He moved one of his old COOs, Greg Peters, as co-COO now with Ted, CEO rather with Ted, and Reed Hastings is moving to be the executive chairman. So we saw this recently with Jeff Bezos kind of taking a more hands-off approach. I think this is probably disappointing to some shareholders who really loved Reed Hastings' very long-term vision, and is one of the reasons that Netflix is what it is today. But he definitely did his time, served a lot, and he's still going to be involved as an executive chairman. So he's not kind of riding into the sunset. At least he still has his hands on the company to some extent. Congratulations to him. He did a great job. And it's great for Netflix shareholders that he's at least staying close, even though this is probably a bit disappointing that he's taking a bit of a back seat on the day-to-day. Moving on to, apologies, I'm trying to find, this chart here is one I wanted to talk. So something that's interesting, and this is really, I believe, in response to some of the narrative and margin multiple compression around the saturation of the media space. Everyone is opening up streaming services. I can't even list them all out or we'll be here all day. And Netflix is really trying to communicate here, hey, like in the grand scheme of media and television, Netflix is still very small. The streaming space is still very small. So you'll see even in the US, who has one of the most developed or the most developed streaming market, linear TV is still 3 times the size of streaming, and Netflix within streaming is only about 8% of the total TV time that's watched. So they're kind of making the case across these markets that as streaming becomes closer to 50, 60, 70% of total watch time, and even if Netflix just holds its share within streamers, we're going to see their engagement across the market here double and triple in the coming years. That's kind of the visual and the case study they're putting together and want you to come to here. So just because there's lots of streaming companies doesn't necessarily mean there's a lack of time to spend on each of these services as it shifts over from linear TV. How much we believe that'll go at the pace they think it'll go, who knows? I know a couple years ago, Reed Hastings says TV's not going to exist in 5 years. That would be like next year or the year after at this point. So I don't think that's going to happen. And they've said that consistently. But at some point, it'll definitely be a smaller part of the average consumer's time spent, and more time will be on streaming. I just don't know where this will go and how quickly, but they're pretty bullish on it. In terms of some of the main components of the earnings call that I just wanted to talk quick, they really did have a long earnings call. They let Greg talk a lot, introduce him more to investors. But there are a couple areas of this earnings call that I just wanted to hone in on a bit. So let me get to them here.
Any thoughts on offering a fast service over time, free advertising supported television?
Ted, do you want to take this one?
Yeah, look, we're open to all these different models that are out there right now, but we've got a lot on our plate this year, both with the paid sharing and with our launch of advertising and continuing to this slate of content that we're trying to drive to our members. So we are keeping an eye on that segment for sure.
So I found that very interesting. I think the spirit of the question, sorry, I think I cut the very beginning of it off, but the essence of it was you've built a huge content base over the years of your own content, and kind of asking if they'd consider doing like a free service or a free TV channel that just plays their content and then they sell ads on it to kind of drive some scale on their advertising division now, giving them another outlet to sell advertising on their older content. That kind of seems like the thing that I naturally think Netflix wouldn't really be too interested in. So the response of openness to opening new profit centers like that, I think really speaks to the state of the market and the reaction to the slowdown in streaming and outlook for sub growth, that they're open to these other ventures and other opportunities to leverage their content for maximizing shareholder value. Another thing they've been doing is dipping their toes in theatrical releases for very limited time periods. So these are all experiments that they're doing that I think long term pose opportunities for Netflix shareholders that really aren't being taken advantage of today by the company as they really focus on being focused on the streaming part of their business, which rightfully so is what this company is today. Pivoting to the second part that I wanted to highlight very quickly and give some commentary behind.
I like that, and that's kind of what you're seeing in the guidance.
And given the revenue drivers of paid sharing and advertising, how are you thinking about price increases in the current year? Is it just too complicated? How are you thinking about it?
Well, I would say that the two initiatives that you described represent the bulk of our pricing strategy in 23. We anticipate that they'll both be, revenue positive, revenue accretive, significantly so, in the according to the details that Spence just offered. Now, having said that, our core sort of pricing approach in theory remains the same, and so we're going to look, at the metrics, that our members are giving us and telling us, and look for opportunities where we've, I think we've done a good job at creating more value for them.
So, what I want to highlight here is it's really interesting how they talk about the password sharing fee that they're planning on expanding out throughout the rest of their business, and the ad tier service. They talk about them both as being accretive to revenue and profit, which is really interesting. I almost feel like they brought these services or these shifts in focus to these areas out as a need to really accelerate revenue and fear that they weren't going to be able to grow subscribers. But then they ended up growing a lot of subscribers, way more than the street thought in Q4. So if they can actually continue driving subscriber growth, that'll be obviously organic revenue growth paired with some of these revenue accretive initiatives on an ARPU level, average revenue per user. We could really see a pretty strong acceleration in revenue. I'd imagine significantly above that 4% forecast that they have, at least for the first quarter. So it's really interesting how they kind of planted these seeds that are going to drive revenue growth. And then the fundamental business seems to be holding up potentially a bit better than they thought when they first planted these seeds. So we'll really see how this plays out over the year. But it introduces a potentially very interesting backdrop for the company.
You will experiment with sports, which is an expensive rental business, for many. Does having an advertising offering change your views on offering sports? And any thoughts that on like WWE, which is for sale, that could be potentially, I'm just saying that could be owned content. Like any views on sports?
Yeah, look, I'd say in sports our position's been the same, which is we're not anti-sports, we're pro-profits, and we've not been able to figure out how to deliver profits in renting big league sports in our subscription model. Not to say that won't change; we'll be open to it, but that's where it's at today.
So I like that line. We're not anti-sports, we're pro-profits. Once again, highlighting how much at the forefront profits are for the company. But to their defense, they've always veered away from investing in sports rights, just very expensive, and they don't really need it right now on their platform. They're providing a lot of value in the areas that they currently play. It's kind of funny to see them reference WWE. I don't think Netflix would be a serious bidder on that. Just very pricey acquisition. Netflix hasn't really taken part in large acquisitions in the past, just like tuck-in acquisitions for small amounts of content. But it is kind of interesting to think about, given how many personalities are part of the WWE, all the spin-off shows and reality shows and everything else they could do with that asset. But Netflix tends to prefer to build from the ground up. So I'd be surprised if they went in that direction. Because that also has a big live component to their business every Monday, Friday night, which Netflix isn't really too invested in. They kind of like binge-worthy material for the most part. So I just kind of liked his comment there and reiterating that essentially they don't dislike sports. They just haven't found a way to make it economically attractive to their shareholders, which once again, more and more talking about making sure their investments are profitable and worthwhile. Going forward here again.
There seem to be so many ways you could drive monetization. I know, like for just staying with Wednesday for a second, like the Wednesday makeup was sold out in every Mac store in New York City. You could not buy it anywhere. Do you participate in these types of consumer products, or is it just a way to fuel fans, fuel engagement?
It's a little bit mostly to fuel engagement and fuel fandom. We do participate in it. Our owned content, we do drive a lot of revenue in our consumer products business, but mostly the motivation is to drive fandom. And Greg alluded to this earlier, but this impact on the culture that this content can have on our platform. In our earnings letter, we mentioned the Lady Gaga song that came back.
So this is an interesting question, poking at potential additional opportunities to monetize behind merchandise, consumer products. And it seems like Netflix has dipped into this a bit more over the last 12 months. But I still think they have so much opportunity here on some of their big franchises to sell more merchandise, more toys, stuff like that. If you look at Disney's earnings reports, they sell billions of dollars worth of royalty rights and consumer products all around the world, and super profitable business. I feel like Netflix has a lot of untapped potential in that sector, that segment, and they're currently still using it just to strategically drive awareness and engagement on new series launches and stuff like that. But I think they have a big untapped potential there of a category they don't really play in that maybe they'll explore more when other growth vectors tap out for them. But definitely a bit of a dark horse for the company, in my personal opinion. I'm going to the last clip I just want to talk from this call.
And so free cash flow, first of all, what an inflection point. $1.6 billion in 22, roughly $3 billion in 23, $4 billion plus probably in 24. Can you talk about, historically you've been more build than buy. Is there any change in philosophy as cash starts accelerating? Can you talk about overall capital priorities and what's driving that operating margin increase?
Spencer, why don't you go first with the capital allocation philosophy, if you like?
Sure. Thanks, Jessica. So as we wrote in the letter, no change at all to our capital structure, policy, or allocation guidance, which is to first and foremost reinvest in the core business and selective acquisitions after that. Those are the main priorities. Beyond that, if we have cash in excess of our minimum cash levels, which is roughly equates to 2 months of revenue, then we'll return that to shareholders through our share buyback program.
Very clear answer there. So they continue to grow cash flow. They're projecting $3 billion in 23. I think they said $4 billion plus in 24. And after they invest back in their business with what opportunities they have, whether that's building out their endeavors on gaming, accelerating content spend, whatever it may be, they'll look for strategic acquisitions that make sense. Once again, they've not played there in a big way in the past, just little tuck-ins for the most part. And then after that, they'll start buying back shares where it makes sense. So very simple capital allocation model. But I think it's more on the cash flows as a whole that I wanted to refer to. This company has over the years scaled up their business with global subscribers. During periods of times, they've spent very heavily on content, which is weighed down cash flow. I think they've kind of hit a peak now where they're growing revenue and users at a higher rate than their content spend, which is delivering some leverage on the business. And they're able to increase operating margins quarter over quarter sequentially. And I anticipate this company to be cash flow positive well into the future. Now, as we pivot away from the earnings call and just look at the the stock a bit. The stock is not cheap, in my opinion. So it's up at about $140 after hours, up 7% on this news. So I know the market went down today. Netflix got hit pretty hard behind it, but up 7% is a significant increase behind that earnings report. So it looks like, despite the company not wanting investors to focus as much on the subscriber count, the investors are still very focused on the subscriber count, given that their revenue or earnings number weren't really miraculous. Their forecast wasn't tremendous, but the stock's up 7%. So value of the company is trading at over $150 billion as of right now, after we add in the after hours performance. And they're looking at making $3 billion in cash flow next year. So company's trading 50 times next year or this year's cash flow. I believe if I did like $12 per share in earnings, are trading at about 29 times forward earnings. So definitely not a cheap stock. But this is a stock that's kind of proven itself over a very long time, of being a company with strong recurring revenues, very sticky product, lots of pricing power, global exposure, and they've really driven a lot of growth for their business, and the scale they've built really, hopefully points to increase operating margins into the future, which should hopefully accelerate returns to shareholders. But for me personally, not interested in the company at the multiples on cash flow and earnings they're at today. But I do have a lot of respect for the company, Reed Hastings and their leadership team, how they've been able to build this company over the years into what it is today. Phenomenal job just at the current valuation. Not something I'm interested in. I'll hold on to my Disney shares for now and hope that plays out well. Looking at some of their competitors, just stock moves. Disney up about 1% after hours on the news. More positive streaming around sentiment, ability to continue growing subscribers in North America and around the globe, likely helping them out a bit. Warner Brothers Discovery up a bit less, half a point, as they aren't as exposed to streaming and all in on streaming as those other two companies. But interesting to see that generally the media space is getting a bit of a slight bump behind these really strong Netflix results. So let me know your thoughts. Did I miss anything big on these earnings? Are you guys invested in Netflix? Are you thinking of investing in Netflix after these results? Would love to hear in the comments. Once again, if you like these kinds of videos, going over earnings call, talking about my portfolio, general business news, stock analysis, please consider subscribing to the channel, liking the video, checking out some of my old videos if you're interested in any of the other stocks I've talked about. And I'll see you guys at the next one.